bit, so we will get started. Again, for those joining, good morning, good afternoon, and good evening. Thanks for tuning in to today's session. We have titled Pricing Health and Life Insurance Products, a practical tool, which is a continuation in the series of microinsurance series. Some of you may have attended the session 2 weeks ago, kind of a panel session of some microinsurance experts talking about actuaries and microinsurance in general. Here we hope to continue that conversation and discuss a practical tool, a Excel and Word based tool that can be used for education and practical applications in microinsurance pricing. Before we get started, just a few housekeeping items. Just a reminder for questions and comments, all mics have been muted. So if you have questions, there's a Q&A box at the bottom of your screen. Please type your response in there. Feel free to provide questions throughout the webinar. We'll be happy to answer them live as we go through forward. Also a reminder that this presentation and recording will be available afterwards. YouTube recording as well as the actual deck will be available on the IA website shortly after the presentation. You can see that and past webinars on the IA website at the link there below. And also here's just a note of the disclaimer from the views of the IAA. Please read that and acknowledge this disclaimer as we move throughout the presentation. Great. So as we get started, I'll introduce the team who's going to be leading the session today. Myself here, Josh Collins, a consulting actuary with Milliman, primarily experienced in U.S. health consulting, but have had the privilege of working on several microinsurance related projects over the years, including this one. I'll turn over to Brian Murky to introduce himself quickly.
Thanks, Josh. I'm Brian Murky. I'm based also with Milliman, based in the U.S. and work in the U.S. healthcare space. I've been in this area for more than a decade at this point.
Great. Thanks, Brian. And Roman?
Yes, Romain de Harlay. I'm a consulting actuary for Milliman based in Belgium, and I work mainly on projects related to life insurance modeling and capital management.
Great, thank you, Roman. And last but not least, Amir.
Hey everyone, my name is Amir and I'm based in the Kuala Lumpur office, Milliman Kuala Lumpur office, and I have about 10 years of experience in mainly in life insurance and family takaful. So looking forward for this discussion today.
Wonderful. So we can tell we're spread across all the time zones. Maybe we match up with one of you out there as well. Great. So I'm just going to give a quick, brief introduction of actuaries and microinsurance. This may be a little bit of a refresh from those who attended a couple weeks ago. But as I suspect many are familiar on this call, what the roles of an actuary are. And within microinsurance, it follows a similar vein, right? And we want to really stress the importance in this as we're thinking about the modeling is the importance of the actuary being involved throughout the entire life cycle of product development and implementation and review. Oftentimes we view actuaries as kind of niche and carved in their role, whether it be reporting, whether it be reserving, whether it be pricing. Whereas what we've seen in our experiences, due to kind of the nations of the market and the non-traditional element of the microinsurance, that it's very important for a actuary to be involved throughout the entire process, especially as they're thinking about the unique elements that make microinsurance a little more different than a traditional insurance. Important that they are involved throughout the entire design phase and implementation, so they can be aware and help guide the process and learn as well to make sure that their pricing and setting up all the assumptions and things in line with how things will be looking for the microinsurance landscape. These challenges here probably are again not unique to microinsurance. They exist in all sorts of sectors for actuaries, but maybe have unique flavors to them. We heard a lot of talk about data availability a few weeks ago, especially as microinsurance is a growing sector, maybe not in a market that has a lot of publicly available data, or if your organization has historically not offered microinsurance, can be challenging. So we'll have a few discussion points on that. Talk about regulatory environment, the regulatory environment may not be as mature. Thinking about the education and cultural barrier, the expertise. How do you think about designing microinsurance? How do the customers and the implementation, the distribution differ from traditional insurance? And then last one, tools and models. That's something that we heard from in some of our work, working through the Global Actuarial Initiative, which is the umbrella in which we're working on. Again, you heard that hopefully a few weeks ago in more detail, which led us to kind of what we're going to talk about today in the tools and models. So quick introduction. So we were kind of tasked with helping develop some pricing models for microinsurance. We heard that from a few stakeholders that we've engaged with who were interested in microinsurance, but really lacked kind of practical tools to kind of get their hands in and get their feet into the market. There's a lot of good theoretical training and discussions and things out there, but really what providing a model that can be taken and adapted and implemented for learning and both practical purposes was a key task for us. So you can see kind of the key goals that we were trying to do, illustrating an approach to pricing for microinsurance, demonstrating effective use for spreadsheet design and building the pricing model. Another key one was communicating the benefits of modeling to communicate a business case. Not just the actuarial pricing, but also communicating to executives, to board members, to finance people, the business case for the microinsurance. We want to think about that, and a few other items there. So as we're building this, we're building a tool that we think is going to be general and applicable. But for those who have used or built any tools, that there's no one size fits all for any case. Everything there's a lot of overlap, but everything needs to be adapted. So we really were trying to balance kind of between those two things. Think about accuracy and simplicity. Think about the data quality, trying to get to as detailed as we could, but recognizing the lack of data availability. So not making it too robust. Thinking about specificity and generality. These things we're trying to find a happy balance between. And through that, we have two models we'll be talking through today. One being a hospital cash design benefit, and one being a credit life and funeral. So our team will be discussing those, and we'll actually provide a detailed walkthrough of the models as well as we go through the presentation. So these would be Excel-based tools. And then alongside each of these, there is a comprehensive user guide, a pretty robust design that you can work alongside, really illustrates each step within the model, how to use it, what it does, and also key considerations that you should be reflecting and debating on and potentially expanding upon as you were to use and learn from this model. So with that, I'm going to turn it over to Brian to talk us through the hospital cash.
Thank you, Josh. Is everybody able to see this?
Looks great.
As expected. All right. So all right, as Josh mentioned, we are talking about hospital cash here, which if we missed it in the blurb there, that it's a product designed in the health space based on hospital admissions. However, it's not intended to pay for any medical care of any kind. It's intended to provide payments to the insured, cover things like transportation for family to the hospital, cover lost wages and things like that. And so it's a really focused product. Part of the reason of this is that beyond the benefit that it provides that is not available to the insured, it is a product that provides coverage without needing a ton of extensive detail in terms of why did somebody get hospitalized, where are they going, what kind of facilities are they using, and so on. Some of that data can be very difficult to obtain and therefore use for a pricing exercise. So something focused on just who is using the hospital allows a starting point in a product like this. So today we'll talk a little bit about actuarial pricing in general. We'll talk about how this particular model is made, the inputs to it, what goes into the calculations, and then we'll show a little bit of the tool and how you might use it. And then some other considerations as if you're working in this space, some things you might add to the model, some ways you might extend it beyond what we've provided here. So in general, actuarial pricing is really based on using the balance of revenue and expenses. In any business has this relationship where profit is revenue minus expenses. In the insurance space, revenue comes from premium, expenses come from claims, and then of course other business expenses. So you might have a version like this within the insurance industry, that you have claims, some fixed expenses, some expenses that are based on premium, and then your profit. And if we set profit aside for the moment and rearrange this equation, we can get a required premium, which is the minimum premium needed to be collected in order to pay claims and business expenses. And so we get a calculation here that if we could project what claims we will incur under a given product, if we can project what the expenses will be for that product, we could work out, well, what is the premium for that product? It's not, this equation is pretty simple and straightforward, but that exercise, there's a lot going into it. And if it were easy, there wouldn't be actuaries, right? But it all comes from understanding the product itself, because the product's premium and product design, the benefit that it offers, all roll into who's going to enroll in the product. And then the people that enroll in the product, therefore, influence the claims that are going to be incurred as part of that product. And so these things start to tie together, that the premium impacts the claims, which then therefore impact the premium. And so that's where a mathematical model, like we're demonstrating here, can really play a powerful role in helping understand what are the factors at play. So as was talked about 2 weeks ago in the first webinar in this series, there's a broad context to these pricing exercises beyond just a single calculation. That there's the whole product design. There's a modeling of who is enrolled in the product and their characteristics. There's modeling of the premium inflows. There's modeling of the claim outflows and how those happen. And then there's just communicating all of that to external parties, other people in the business. And yes, the premium calculation is hiding there in one step, but there's a bigger flow of work at play that the actuary plays a role in. And all of this modeling comes from this initial starting point of defining the scheme or defining the product that is being offered. Because once the product offering has been defined, then you can get a sense of who might enroll. Then you can get a sense of, well, what kind of claims might they incur, and then therefore get a sense of how well the product might perform as a business. So in this model that we built, we took that full spectrum into play, and we built in parts of it for defining a scheme. We have modeling of enrollments. We have modeling of the premium revenue being brought in, modeling of the claim volumes being incurred, and then the payouts happening. And then finally, we have some summary documents that help communicate what is the model telling us. And all of this is just in recognition that this long flow is really crucial to effective operating of a product. So the model inputs in this model are all kept on one page, so that the user can open this up, can put in some numbers that maybe they're playing around with some numbers, but ideally they get something from a source of some kind to base their projections in reality. And then, so these inputs all come in on one tab, and then the model makes some calculations, and the results pages are shown as a result of that. The first part of those inputs is simply the scheme design, setting up what will this product look like. And there's a few different parameters that the user can specify, length of coverage, how long, if they make a payment, how long does that policy then cover them for? Is it 6 months in this case, or is it 1 month? Whatever it might be. If the term is paid in full or is it paid monthly? Is there a waiting period that if somebody pays their premium, do they have to wait before they incur a claim? Do they have a policy deductible where they're in the hospital for a few days before the benefit kicks in? In microinsurance, some of these parameters are not often part of these products, but we wanted to include those to so that the user could see what is the impact of including parameters like this on the business performance. Just because it's difficult to measure the enrollment impact of some of these. And then we also have the payment rate of what it is that the insured will receive per diem, the per day that they are in the hospital. So those are all part of this, just the initial setup. After that, we move to enrollment and retention, and there's a lot of different ways one might project this. We chose to allow you to specify across a 5-year period new enrollments per month. So in this case, projection year 1, you put in 100 policies, and so every month 100 policies are added. At the term or at the conclusion of their term, we have a rate for how many or what fraction of individuals re-enroll in the policy, as well as if there's a monthly payment rate, who disenrolls within term. So this helps control the initial ramp up of the product, but then also how large the product might be after some time. Now that population is covered, we put in some assumptions for the distribution of the demographics. In this case, we have male, female, and child coverages, and these form a different component of your overall 100% covered population. And we have these splits because the hospital admission rate is often quite different for different demographics. And this allows the user to put those in separately for each of those demographics. So that is the hospital admission rate up in the upper left here. We have an adjustment factor that might influence that. Maybe a new clinic is scheduled to open after a few years, and maybe that clinic is anticipated to keep individuals healthier, and so therefore the hospital admission rate may drop. And so there's a adjustment factor that's allowed to be included there. And then once the individuals have been admitted to the hospital, they'll be staying for a period of time. And so we have a distribution here of for example, for the male population, what is the number of individuals admitted to the hospital that stay for 1 day or stay for 2 days or 3 days and so on. And this is intended to help the user understand the impact of some of the deductible days. If they have to wait 3 days for a benefit, there's a large portion of the population that their stays will generally not reach that deductible. So that could be discussed as part of product design. Is that a feasible product for the market? These parameters are made available. They can be difficult to measure in practice. And so I'll show later that we do have an example way that somebody might track this sort of product and track the experience that a product like this is incurring, because experience is a great way to, if you have a product on the market and you can track the experience, it's a great way to feed that back into pricing, to refine pricing over time. The other element of expenses, balancing premium besides claims, is non-benefit expenses. And in this model, these are made available both as % of premium expenses as well as fixed expenses. So something like a building where the administration of the product sits, that might be a fixed expense, the rent for that or the lease for that. Whereas a commission paid to a distribution network may scale based on may basically be a portion of premium and therefore scale as more enrollments are brought in, that expense should scale accordingly. So two different ways of representing expenses in this model. And then we've also got the income tax accounted for and a net present value discount rate, so that some of the summary exhibits can be shown in there as their net present value for accounting purposes. And finally, once all of those elements have been entered in, the model calculates the required full-term premium rate and allows you to compare that to an input value. So in this, we'll see in the file that these blue cells on the left are the inputs. And so this is where, as part of the scheme design, you would put in and you'd say, well, I think the market is able to pay 45 currency units for this product in year one. And now as a user, you would be able to take that, compare it to what the model calculates as the required premium, basically the premium with zero profit margin. And that comparison then gives a sense of what is the overall profit margin of the product, and get a sense of, is this a sustainable business, or do some element of either the premium being collected or the scheme parameters need to be adjusted in some way. Right. So that's the inputs. Just running the gamut from setting the scheme to setting up enrollment assumptions and claim assumptions, the expenses, and then finally what the anticipated premium rate being required is. So I will show now in the Excel model what this looks like. So first of all, when you download the model from the IAA website or the Milliman Gain website, you'll get an Excel file. You'll also have a PDF with the user guide that we'll show shortly. When you open the Excel file, you'll see a license tab, and with the required licenses here, and there's this agree and unlock button. If you click that, the model now opens in its full state, and you can save this and use it in all different ways. This hospital cash user guide button brings up the corresponding PDF that you can also access from within the Excel file here. And that gives you easy access to the resource, to the user guide to help walk you through how the model works. This instructions provides a little bit of a summary of the file itself and how to navigate. And then the different tabs include different components of this model. So I'm going to jump to a version where we have some fake numbers entered. So if we go to the input assumptions tab, you'll see these different entry boxes that we walked through in the slides. So we have a number of elements. We can change these in all different ways. But we have these entered in here. And those, now that these are entered in, everything flows through automatically into the other tabs. So right now, the premium calculations tab takes the enrollment assumptions and brings those into a calculation. This does enrollment calculations based on cohorts, based on the starting month of enrollment. The user guide talks about this way of looking at the dates in the model. And so these calculations are carried out, and we get some summary visuals of overall enrollment and how that's changing over time and based on when someone first enrolls in the product. So enrollment and premium are carried out on that tab. The claims calculations based on these distributions of number of days and the total admits are pulled in, and then the policy deductible and benefit maximum parameters are pulled in to get the overall number of covered admits and covered days compared to the overall just days and admits in the hospital. So the parameters are pulled together with those stay assumptions. And then some summaries are brought together so bringing the enrollment, the premium, and the claim payment parameters all together into one spot to help serve some of these summary exhibits here. So the first summary exhibit we have is it covers the premium rate development. And so this again is the core calculation that we were carrying out happens here. And it happens right down here. You can see this formula is taking all of the inputs, the projected claims expense, the projected non-claims expense, and rolling that into the total required premium. But all of these other elements derive from the spreadsheet calculations on the pages before. This premium rate development summary is intended to walk through step by step to some extent of that calculation and provide good evidence of where those numbers are coming from, why the premium ends at where it does, and how that then someone might use it reporting out on the viability of this product as a whole. Similarly, the financial statement tab this provides a little bit more detail than the premium development tab. This is intended to have sort of a business summary of the performance of the product and sort of match what might appear in a general ledger. Things like the total premium, revenue received, the total claims expenses paid out, and the total non-claim expenses, and everything is part of that. This also includes some key performance indicators that some proposed metrics for tracking a product like this to understand, is this product performing well or not? Because oftentimes profit it's a necessary indicator to track, but it's not the whole story, especially if a product has a lot of front-loaded expenses that will get balanced over with net profits over time. So this financial statement is intended to cover a lot of that overall business summary of the product, as opposed to just focusing on the pricing component of this product. And again, as you change inputs on this assumptions tab, all the calculations and the outputs will adjust accordingly. And finally, there's a summary experience tab, which is a proposed way of tracking a product if there's a product on the market, tracking the experience of this product, where you can track claims that were paid out. So a single admission, you might put in some information about who it was, the dates, how long the stay was, how many of those days were covered, and so on. I may also consider if it's possible to track where was the hospital. So then are people using a certain facility more than others? Maybe there's a way to track the condition. Did they have an injury? Were they sick with an illness? And tracking that, and that helps you understand why are people enrolling in the product and where are they finding their most benefit. And potentially that helps with product design, helps with support of the insured, and so on. If you are tracking the claims expenses over here in this section, over here you can add in the number of enrolled policies, or you could also similarly track the enrollment of each policy one by one. But then what this lets you do is take some parameters from this captured experience and drop these into the model input. So for example, if you've tracked all of these stays and you want to put in these total admits per 1,000 individuals, you can go and drop that down here in the admission rate entry. All right. So that is the Excel file. I will show a moment here the user guide, which you can see the cover on Josh's slides. But this goes through in some detail, talking in depth about each of these input parameters in the scheme, as well as talking about how the calculations are carried out, and even some navigation, for example, some navigation of the calculation tabs themselves to help you understand what is being carried out, why, and some thoughts around that. So this we really intended this, the user guides, to be used in conjunction with the file themselves to ensure that you are getting a full introduction to these products. I will jump back here. And I talked through these premium development and financial summaries already. KPIs. So finally, to kind of bring this model discussion to a close, some elements that we considered putting into the model, but for simplicity, we chose to keep out, are shown here. Some examples like adding additional elements to the scheme design. For example, maybe you only cover certain facilities that you, as the inpatient stay. Maybe there's a maximum age. These restrictions can be a bit difficult in the microinsurance space, but they are things that might be needed for certain products. Some elements you could, for example, if you're entering a new market, you might look at the current market and to understand what is a reasonable rate for pricing. We did not attempt to capture the market rates or anything like that. There's other elements of expenses that we did not put explicit entry spots in for, but those could be included in a general business expense. And then finally, some other policy considerations, for example, family coverage. This was built as for a single insured coverage, but with some tweaks, we think the model could be expanded to include something like a family coverage. But that gets to be a little bit more case dependent, so we left that as future expansion. Some other potential ways that this could be expanded is pulling in some public data source or other research in a bit more specific way. There could be ways of streamlining the Excel calculations or enabling it to represent a suite of products. And maybe there's a lot of related products. We did not do any sensitivity or scenario testing within this model. We discussed that process in the user guide. But that's certainly a way that this work could be expanded as well in the future. So I think that covers our discussion of the hospital cash product or hospital cash model. And unless there's any questions that have come up at this point, I will pass it over to the next topic.
Yeah. Thanks, Brian. There haven't been anything significant in the Q&A. There was one discussion or request to get the link to the toolkit. So you can see in the chat now, Meet has placed that there to the IA website. We'll also follow up with where you can download it from the Milliman side as well. Maybe before we switch over, though, since we were making good time, Brian, if you could bring up the user guide, we could maybe add a little bit more commentary of the additional sections of the user guide that are kind of above and beyond what we have in the model. So hopefully this summary kind of give you a little bit of context. Maybe go up to the table of contents.
Sure,
We can just do a quick overview. So as Brian noted, this the user guide, and this mirrors what we'll see on the life and funeral side as well. The intent of this user guide is really to be a walkthrough of the model, so you can have the model up on one side of your screen and this on the other, and it'll go step by step, input by input, section by section, as the user would interface and use it. This has details of what each of the sections are responsible for, what they do, as well as some additional considerations. And then following that, I think section maybe 5 through 7 are kind of some additional considerations. So Brian referred to a few of these scenario and sensitivity testing, discussion about how you would consider that, acknowledging it's not built into the functionality of the model, but you would want to build your own type. There's conversation around that. Talk about the experience use. So we have the experience capture, the data recording option, but what are other considerations? And then other things about moving forward in the model, how you should own, adapt, and extend the model to your own purposes. This model will be totally, open source, so that you can adapt and save and adjust and adapt it to your own way. And then after, we have a few appendices, right, that talk about other modeling topics, and also a really robust overview of all the Excel functions they used here. Acknowledging that this tool itself could just be a general Excel functional education service. We tried to limit the complexity of some of the inputs and formulas that we're using, but recognizing the level of Excel accessibility and comfortability may be different among all the users. So we really try to address that with an appendix that really goes through all of that. So we really hope that this user guide creates a very easy access point for any user, whether their background is microinsurance, actuarial, finance, etc. This hopefully will flesh out all the pieces that you may not be as comfortable with, and equip you to use the model. Great. Yeah. Anything, Brian, there?
That's a good overview, Josh. Thank you.
Perfect. Okay, and we got one more chat here. Again, just sharing the documents. That link that was placed there and placed in the chat is where both the tool and this user guide are saved. So feel free to access those as we conclude. So, all right, I think that's good. We'll pass it over to the life and funeral team, and they'll take us through the next model.
Yes, thank you, Josh and Brian. Hopefully you can see my screen properly.
Yep, looks great.
Yep. So we'll now move on to the credit life model. In this part of the discussion, we'll cover the goal of the project and the tool that we have built, how the tool has been constructed. Then Amir will provide a live demo of the tool and how it can be used. And we will finish this discussion with final pricing model considerations. So the goal of the project and the tool that we have built is to provide an available, accessible, and easy to understand life microinsurance pricing model. It highlights the different steps and considerations that need to be taken into account when conducting a pricing exercise. The main aim of the tool is really to be educational for self-learning, or it can also be used for session in a classroom. So it's not meant to be used in a production environment as it is as of now. And the tool also comes on top of the premium pricing part with high-level business planning overview that enables to provide a view of the impact of the different assumptions and product characteristics on the future profitability of a product. So this slide provides an overview, a general overview of the different steps of the model and of an insurance product pricing exercise. So we start first with the product parameters or the product characteristics. So in here, that would be what are different coverages that need to be included in the product. Is it only a credit life coverage, or is there also a funeral expense coverage in there? For how many people, and what are the characteristics of the policy holders? Then the model moves on to the assumption setting exercise. So there are a few different assumptions that are needed to derive a premium. There are economic assumptions, which are, for example, the discount rate that is used to discount the future cash flows, or the expected investment return. And on the non-economic assumptions part, so they will be like the claims frequency, so that can be based on the mortality table. There's also assumptions that need to be made on the variable expense level, the commission level, and potential additional loadings. When putting those things together, it is then possible to calculate and determine a premiums for the product considered. And this part also involves an analysis of what is inside the premium, what can be allocated to the actual risk coverage, and what is allocated to the other components of the premiums. And then this premium can be used in a financial projection or business planning exercise, where the future sales can be projected, and a potential profitability of the product can be assessed. It's also possible in that step to perform some stress testing of the main assumptions, or the most important components of the model, to derive important insights and to know on which assumptions more effort is needed. And once that is done, the model also comes with an aggregated summary dashboard, which provides information on all the most important results of the tool, and charts of the results. So we'll now move to the different items of this overview, with also extracts of the tool itself. So the tool is built in Excel. This decision has been made because Excel is usually considered to be easier to understand than a programming language, and it's also easier to follow the different steps in a calculation. So for the product parameters, as you can see in 1 and 2, it's possible to select only a credit life coverage, or also a funeral expense coverage. For the credit life product, it's possible to define it as a joint life, so where the benefit is paid on the first death, or without a joint life, so only on one policy holder. The sum assured can be defined, and also the maturity of the product can be determined. So after this, we move to the assumption setting part. As I said before, there are economic and non-economic assumptions. As part of the economic assumptions, here we show that the discount rate can be given together with also the interest rate of the underlying loan that is covered by the credit life product. And then on the non-economic assumptions, so the claims frequency can be derived via different options. Either it can be based on the mortality table, if there is enough data that is available, or if that's not the case, then manual inputs can be used, as it is more straightforward. Next to these claims frequency assumptions, there are also expense and other loadings, which account for the variable and fixed expenses, and also the commissions, of course. And next to that, it's also possible to aim for a specific profit margin and a potential mortality buffer, which can be interesting to use in case there is some uncertainty on the claims rate that have been given to the model. And the last part here, the tree business volume, is used to give to the model the number of policies that is expected to be sold, and also the lapse rate, so the proportion of the policies that are expected to be terminated before the maturity of the product. If we move then to the projection assumptions, so these assumptions are only used for the business planning / financial projection part of the model, so not for the premium pricing part. So there are assumptions that need to be provided on the number of sales across the 5 years of the projection horizon, a potential investment return that can be calibrated based on the investment mix of the insurance company. There's also input to be provided on the tax, the potential expense inflation, and the fixed expenses per year. And it's also possible then to determine premium increase and claims increase level in the future. So next to these base scenario assumptions, it's also possible to make some stress testing. And for that, the tables here will need to be filled. So stress testing on the claims level, lapse, expense, and commissions level can be performed. So yeah, stress testing I think is an important risk management tool to be able to identify the vulnerabilities of a model, and also to know where to put more effort in order to estimate as precisely as possible specific assumptions. So this then brings us to the premium pricing exercise, where then a gross premium will be provided, and also a breakdown of this gross premium between what is allocated to the actual risk coverage, with also the different coverages within that, and also the allocation to the different loadings. So as we can see, the mortality buffer, fixed and variable expenses, commission, and profit margin. And then there's also an additional table that is derived from the business planning exercise, with a view on the profit margin, the internal rate of return, and also the expected payback periods. This slide here provides a bit of a closer view on how the financial projections are built. So all the main cash flows of the model are projected for 5 years based on the assumptions that have been provided to the model. So in this cash flow, so we have the premium and the investment incomes on the revenues part, and on the outgoes part, we have the claims, the expenses, the commissions, and that enables to derive an expected profit before and after tax. And then below, we also have an aggregated view of those different blocks across the 5 years, and the average of these values per policy holder. All this information is then fed in this aggregate or summary table. And this chart that we can see on the right, that provides a view on the expected income and expected outgoes per year, which can be translated in a cumulative net income in green in the chart. And the table provides then a breakdown of the revenues and the outgoes per year. And again, so the net income and the average of these values per policy holder. So this type of dashboard can be used for external communications with other stakeholders than the main team. And it provides a clearer guidance on the impact also of different assumptions. So next to the business planning and premium pricing, we have also added to the model an experience analysis tab, where it's possible to compare then the assumptions with the realizations. So this is back testing per se, so where we can compare the expected versus realized, and that's also an interesting exercise to conduct in order to know whether assumptions need to be refined and whether they can be trusted. But this can only be used after a few years of existence of a product. But it's important to have such a loop that is put in place where the assumptions are compared to the realization to refine them on a regular basis. Yeah, and we will now move to the live demo. That Amir will take over.
Right. Thanks very much, Roman, for the explanation on the model. Let me just share my screen. Do let me know if you can see the screen.
Yes.
Okay, great. So yeah, I'm sharing the model for the life microinsurance pricing model. So similar to the hospital cash model, when you open the model, you'll basically look at the license page. Essentially, what you need to do is then agree and unlock, and then it will then unlock all these other tabs for you to further explore. Now, I'll just go through the different tabs and perhaps focus on some of the things that wasn't really shared in the slides for further elaboration. In the README tab, similar to the cash model, we have some simple instructions in terms of how to use the model, and these are quite simplified instructions for each of the tabs, as you can see here. And we also have embedded into the model the life microinsurance user guide, which you can double click and it will open to the user guide for the life microinsurance pricing model. Now, if you have any difficulties to open the file in this embedded mode, please don't worry. We also share the link that was shared by Meet will also have both the live user guide and the model separately as separate links, so you can download both of them separately, and you should be able to access them both accordingly. Moving on to the input tab. So this is, as what Roman has explained, it essentially contains all the important key assumptions that you need to input to firstly come up with the gross premium, but also we have the financial projections, and if you scroll down, then you'll be able to see the section on projection assumptions and stress testing as what Roman has outlined in his presentation. We've color-coded it here so that it's easy for the user, where the green cells are for inputs and the gray cells are for calculations. So you don't have to worry about the calculation side. These are all basically, they're formularized essentially, so you don't have to play around with it, but you can obviously have a look at it and see what it's trying to do and to learn a bit more on that. So we have the economic assumptions, the product parameters, where you can select what kind of benefits the product would have. Would it just have the, for example, would you only have just the credit life and no funeral benefits, or you'd like to have a combination of the credit life and funeral benefit for the policyholder and for the spouse, for example. As mentioned by Roman, there's also a capability to whether you want to have it on a joint life basis or a single life basis on the credit life product in particular. Moving on to the pricing assumptions. So Roman mentioned that there are different methods of selecting how you would like to determine the claims frequency, the claims rate, essentially, you'll see here there's one by entry age, by demographic, and by manual input. So these are basically, you can just select from the drop-down option here, the different options that you like to select. For example, if I selected the by demographic, then the Excel would basically change to the different selections. So for example, on by demographic, you would basically populate what would your average expected demographic of people who would be buying this product by male, female, and child, male and female, for example. Or if you would have the by entry age, then you would have to input the entry age and by gender, male and female, for the policyholder, the spouse, and the child, if applicable. So yeah, then by entry age and by demographic, as mentioned by Roma as well, it really depends on the mortality table that's being used. So we have a section here, section 4 on mortality tables, that you would need to input in by yourself. We have it by different age groups, as our approach would be on different age groups, but essentially, if you'd like to have it a bit more accurate by different years specifically, that could be further enhanced in the model and by adjusting the calculations as well. The last point would be if it's by manual input, and if it's by manual input, and it's basically bolden here, and you just need to put in the input for your claims frequencies, irrespective of what's being calculated here. So this is if you have an understanding of what you think the claims rate would be, you can put it in there. Aside from the claims frequencies and margins, there would be the expense and other loadings, as mentioned. So commission loadings, variable expense loadings, any mortality buffer for any adverse deviations from your experience, if the company would like to target specific profit margin loading. And we also have some lapse rate assumptions that we use in the calculation of both the premiums and also the financial projections. Moving on to the projection assumptions, this would basically have the projection is a 5-year projection, which you need to include in what's the target sales that you'd have, the expected investment returns, any taxes, any inflation on the expenses, on fixed expenses, the assumed fixed expenses. And as we've mentioned, there's also the ability to adjust the premiums and the claims rate increases if you want to. If not, then that would be a fixed, the gross premium would be fixed across the years. This is essentially just if you'd like to test and see what happens if your claims rate increases a lot more than your premiums, for example, and how that will affect your profitability or your cash flows. And we also have the stress testing, as I'll show in the financial projections. We have the stress testing on the claims, lapses, expenses, and commissions as first basis. But obviously, if you have any ideas on other important assumptions that you like to stress, then you could always enhance the model to allow for that. So this is not something that's being explored in the slide. So this is the premium calculations portion, where it has different sections that ultimately then calculates the gross premium in row 69. So you'll be able to see from rows 2 to 30, that would be the calculation of the decrements, generally based on the assumptions that's being put in the input tab. You would have it both on excluding the mortality buffer and including the mortality buffer. So you have 2 different sets. All the calculations are basically, all of it are grayed out because these are all calculations based and not requiring any of your input, but you'll be able to see the calculation and sort of study and see what it's trying to do. So we have the decrements by member, spouse, child, and if joint life is relevant. And then we would have the credit risk premium calculations. So this credit risk, the credit life is basically upon the reducing term assurance. You'll be able to see that the sum assured amount will be reducing in time. And we also have the funeral benefit risk premium, where the assumed benefit is constant throughout the months. Basically, these are all in months, by the way. These will all be concluded in the calculation of, this is basically the summary of the annualized risk premium, and then basically allowing for all the other loadings and any profit margin or any commission loadings and variable expense loading, you have the calculation of the gross premium over here. So generally, this is the main engine of the model to calculate the gross premium. It would then have a summary of the premium analysis essentially here on basically splitting it out, the premium based on the risk premium and the loadings on different percentages, and also as mentioned by Roman, the different pricing metrics, the IRR, payback period, and profit margin. These are what we think are the sort of popular or main items for pricing actually when they are pricing the products. Moving on to the financial projections. We essentially, as mentioned, we have a financial projection of 5-year period, and we do it on a monthly basis. So if you extend this these cells, you'll be able to see the decrements on the main life, spouse, and child, but we'll be able to hide it. And in case you don't want to look at the decrements and you want to focus on the main things, these are the main cash flows. So we have the premiums being projected, allowing for the decrements. So all of these cash flows are allowing for probability in force of the decrements. So you have the premiums, projection of the claims by credit and funeral benefits, the expenses on variable and fixed expenses, commissions, which we assume to happen once every year, investment income, the projection of the reserves, which is on the unearned premium reserve basis, assuming there's a short-term product, a yearly or one-year term product, and the calculation of everything up to the profits before and after tax. So these are all on the monthly projections, and we have it then basically summarized on a yearly projection. And using the assumed sales assumptions that you've put into the sales part here, you'd be able to then assume new business sales for each of the 5 years. So we have the new business coming in the first year, the second year, third year, fourth year, and so on and so forth, on top of the in-force projections that we have, to sort of simulate a sort of stacking model or what would happen if new customers come in and you're able to reach the target sales for each of the projection years. This would be what you've seen in the slides, whereby the total projections are then basically summarized. So this would be the in-force and new business cash flows all together, and you would have some summary of the important items, for example, the gross income, total claims, total expenses, total commissions, and some handy averages and factors, percentages that would probably help in terms of your analysis. So you notice, for example, in terms of the claims, there are the claim stresses. There would be claim stresses that's being put in the financial projection itself. Even on the expenses, there are some expenses here. So that just links back to both the premium increases, claims rate increase, and the stress test parameters here as well. So if you adjust any of the items here and having your formula set to automatic calculation, then those would just flow into it would be updated in the respective columns, and it will be reflected in the updated calculations of the projections here. So this is basically just a projection of the business planning, as Roman has mentioned, just to see whether after you've priced the product, whether selling, if you assume a certain sales amount, does this product make sense? Would it reach the target profits that the company may be trying to aim for? And just seeing how the premiums and the claims trends would go based on essentially long-term projections here. Now, the summary tab is essentially the same thing. It's just, as Roman mentioned, a sort of a dashboard sort of formatting, whereby you could basically use this for management presentations, just to show on a high level how the profitability looks like assuming we sell this amount of sales on this amount of premiums. This is the target, and we have a sort of like a graph that will also be updated if you change any of the assumptions there. It will reflect automatically. So that would be the main bulk of the model. As also mentioned by Roman, there's also an experience analysis tab here, where it's also important to monitor your experience generally, especially on your mortality experience, especially if you don't really have that strong of an assumption. So you ideally you'd be able to populate it for at least 5 to 10 years, and then you get the average assumptions. You get the average assumptions here, basically proposed assumptions. Then you can basically monitor and compare that against the pricing assumption and see if, for example, you need to reprice the product because maybe the mortality, the claims rate that you've assumed is slightly lower than what you currently are experiencing. So yeah, this is just an important cycle in the actuarial control cycle, whereby after you price product, you also need to you need to monitor the experience, and then if required, you need to make some tweaks to the assumptions, and if you want to sell the new product, then you have the credible information that you can then further put into the mortality table rates or your manual inputs, for example. So this is the model that we'll be sharing, and hopefully you'll be able to download and have a look. I'll also share have a look at the user guide, which I will share now. So hopefully you'll be able to see the user guide. So once you download, this is the user guide, and similar to the hospital benefit, hospital cash model. This user guide basically brings you through the whole model and goes step by step on the input assumptions, the calculations, premium analysis. So all of it is being explained in more in-depth as compared to the README tab. So definitely have a look at this before going through, or perhaps look at it while you go through the model, because we explain on how you would set the assumptions and how it works, what is the calculation trying to do. Some nuggets in terms of what would you need to consider when setting product parameters or when setting assumptions, what you need to consider. So those are some of the information that is not really available in the model, but we would document it in this document. So it would be a good read for you to have a go first, and before playing around with the model, or together when you're playing around with the model. So I will stop there and let me share the rest of the presentation. So we've gone through the model, and just to highlight a couple of things before we end the live model presentation. There are some considerations when we're pricing a microinsurance model. Usually, we like to keep it suave. So that stands for keeping it simple, making the model and the products easily understood. When you're coming up with a product, making sure that the product is easily accessible to the general public, because it's for microinsurance, and so having it maybe accessible via phone, or easily accessible to the target market, that would be ideal. It has to be valuable. It has to serve the needs of the target market, and it also needs to be efficient, not similar to any product that's being priced, or any product that is being developed. It needs to be efficient. So always remember to keep it suave when you're thinking about pricing microinsurance products. So the assumptions, you also need to consider internal data or if internal data is not credible or not sufficient, then external data. So explore looking at mortality tables from certain countries would have mortality tables, like in the UK, in Malaysia, we have our standard national mortality tables that you can have a go in using. And as we mentioned previously, experience monitoring is also very, very important. Just also to highlight, there are many different approaches to pricing and financial projections. So you need to consider the accuracy and practicality when conducting the pricing. And yeah, I think it's similar as what Brian highlighted in the hospital cash model. Our goals are basically to develop model an accessible model to illustrate what's the approach to calculating premiums for a microinsurance product using Excel, because it's easily understood, and also ensuring that not just coming up with the premiums, but also coming up with business projections to then communicate to the stakeholders on the viability of this product. And ultimately, we are producing this model and the user guide as a tangible educational resource for use in the classroom or for self-study for those who are passionate in microinsurance or in actuarial studies. And that would be all from my side. I'll pass it back to Josh, if that's okay.
Wonderful. Thank you, Amir. Thank you, Roman, for walking us through the life side. As Amir was highlighting the question slide, I think what I'll do here is I will just go through. We had a lot of good questions come through the Q&A. So if you haven't had a chance to see those, I'll just share the deck so we have something to look at while I walk through the Q&A section. So, but if you have other questions as we work through these, please continue to put them in the chat. We have a good amount of time saved over to make sure we answer any questions about the tool, about the use, anything there. So the last time I jumped in, I'll just go through the questions we received in the meantime. One of them being, is the license open to be used freely? I can use it with my students without copyright infringement. Yes, the answer, these tools do intend to be totally open access for you to use. There's a lot of disclaimers and caveats about using them for actual practical purposes. Those are totally on your own accordance, but we do hope this tool can be used as a platform for education, for learning, and adapting for your use. We had a question about other language availability. Right now, the tool is currently only available in English. We wanted to do that first as the most accessible language for now, but we will be evaluating further translations as needed. So if you have any feedback related to that, please share our way. We had a couple questions related to opening up the model. I'll do a quick demonstration at the end here, once we've gotten through all the questions, in case other users are having similar issues with opening the tool. We had a question about documentation on setting assumptions, and noted that there can be varying different results of morbidity with even the same product design. And the question suggested that one of the biggest variables is overall management and skill of the organization implementing the scheme. And certainly this is a discussion point within the user guides. We don't have a prescription of how you would set the assumptions and exactly what the numerics you should associate with it. But these are the sort of questions that you need to be considering as we do, when we have hopefully some talking points and helping you at least think through them, which would give you a stepping stone. But setting assumptions, as we all know with any model, is just as important as the model itself. So careful consideration needs to be gone, and detail, gathering data where you can, utilizing existing experience about your organization. But really a part of the actual control cycle is ultimately product has to be set up to market, and then it's really analyzing the claim, assessing the claim, and looping it back in and revising assumptions is key, and making sure that your risks are contained during that whole cycle. So we have a lot of discussion around that in the user guide. We had a question about allowing for stochastic mortality projections. And as we noted, that certainly is a use case in implementation. We do not have that functionality built in. However, the tool is unlocked for you to adapt and adjust in your own way. And totally stochastic modeling, scenario testing, sensitivity testing, all these great actuarial tools in your toolkit are further excellent ways of adapting and expanding the model. A couple questions on access the model, and then there was some guidance there about how you can use the macros. So since we haven't gotten any questions there, what I will do is I'll just quickly demonstrate how you may see the Excel if you're having trouble accepting the user agreement. So if I share, I just downloaded fresh from the IA website the hospital cash model, and you may open up and you may see in your Excel this security warning says macros have been disabled, enable content. And if you were to have tried to press the agree unlock, you get a pop-up saying that macros are not enabled. So that for me, I just click this enable content button here. Now we get the pop-up that notes you must agree to the licensed cameras before using the tool. Acknowledge that I hit yes. Now I can hit agree unlock and the tool unlocks. So for those maybe who are getting stuck on that, unable to press that button, hopefully that will resolve. In the chat also, Krista put in some tips too that says if you're using the latest version of Excel, you may need to take a few extra steps to enable. Krista noted you might right click on the file, select properties, security section, check the box for unblock, then click apply OK, and then maybe you can follow the steps I did there. So if you're still having issues, I'm sure looking up and understanding your Excel specific can help there. All right, and then we have one more question that was asked in the chat. Says, could this model be adapted for emerging markets with limited data, or will it need to be adjusted to consider these market features? And I think the tool itself is kind of static state for any ready to be adapted to any market. If you're looking to adapt it and apply and take some of the concepts and apply it to your own tool, it will certainly need to be adjusted. This tool is designed to be off the shelf as an educational and discussion point, but can be adapted to your own purposes under your own risk responsibility for whatever market you enter. So if it's an emerging market, limited data, we have a lot of discussion about data availability, how you can think about that, but ultimately the best data will be your own data once you resolve there. All right, wonderful. We have more questions coming in. I'll maybe pass these to some panelists here as well. So we have a question. If the actual claim experience turns out to be worse than pricing assumptions, at what point should one take action, and what action would need to be taken depending on the differences noted? I know we have kind of a claims analysis or experience analysis on both sides. I don't know if Roman, Amir, either you want to kind of just take a perspective of what you would take from a life side. Amir, I know you're walking through the model. Maybe you want to take that first pass.
Yeah, I'll have a go, Josh. So I think it's important to understand to try and understand why the claims experience has go about that way. Is it just a one-off kind of thing, or is it steadily showing a steady increase of worsening? So importantly, if we understand what's the cause of claims experience, and for example, if it's deemed to be something like a one-off, like COVID, for example, then it might not necessarily be a cause for you to reprice the product, for example. Or on the flip side, if you see that it's a steady trend of the experience steadily being quite worse than what you have, then you need to then think about do you need to reprice the product, or is there any other conservation attempts that you can do to improve the assumption. So that's just my 2 cents on that.
Great. Thanks, Amir. Yeah, maybe I'll add a little bit of perspective from the health side. I think there's a little bit benefits as more of a short-term product, right? So you have a little bit more opportunity in real time to refine and adjust renewals and pricing there. So in terms of what point, it's hard to put a stake in the ground. Where is the exact point? But the key is continued analysis of your experience, continued evaluation, understanding root causes, understanding which assumption maybe you made is the one that's deviating from a hospital side, for example. Is it the length of stay? People are staying longer than you expected. Doing it. Is it the frequency rate? Is it certain demographics that are causing different evaluations? But really comparing actual experience to the assumptions underlying and identifying where the root causes is key to be doing live and quick. All right, so if a lot more questions are going in, we'll try to get through as many as we can. One question here, talk about how does the model toolkit handle limited and poor quality of data, which is common in microinsurance market, and then a follow-up, how can microinsurance providers balance affordability versus sustainability and pricing? I don't know, maybe Brian, you want to address at least maybe the data side, and if you want to take a stab at the second piece too.
I'm happy to. So both guides talk a little bit about the data quality question, which is indeed a big unknown. And part of that we suggest in the user guide some places somebody might look for such data, including public sources, including similar products, maybe some market research. And just there's, especially when a new product is being offered, some creativity might need to be involved in looking for data, as well as actuarial judgment, trying to pull those data sources into something that's relevant and making adjustments for the product. But once a product is being offered in the market, tracking that product's experience is pretty critical because you get firsthand experience into what is happening with the product in a way that you don't with public sources. And you can really tie that experience to the benefit design, to the distribution network, to all sorts of elements of the product. So tracking is pretty critical.
Great. Thanks, Brian. I'll maybe add a little blurb about the second piece about microinsurance providing balance, affordability versus sustainability and pricing. I mean, from my perspective, the answer is you need to think about both and not neglect one versus the other. And that's really what we try to address in the structure of the model, is how you can think about it both from a pricing perspective and which, needs to be met with the market demand. What is the price void? What is the market need for the price? But also we have the cash flow projection and the business side of it, right? So that as we project out, is this a sustainable product? Thinking about both in the short term, about sales and access and meeting the market need, but also that it's going to be financially viable long term for the organization offering it. So that probably doesn't give exact steps, but I think the key is making sure both of those are being held in tension and being evaluated. And we really try to drive that home in the user guide and the model development. So we'll note that one there. We had another question related to, acknowledging would have been great to see stochastic morbidity modeling. Definitely take that feedback. Appreciate that. And then, is it possible to use an African environment with limited data? I think this echoes basically what Brian was saying in terms of data availability. It's not a unique concern to the African environment. There's a lot of market segments or even microinsurance in markets we have more established traditional insurance. Understanding that micro experience and the customers and users of those products will likely have different experience than your traditional experience, even if there is more robust data sets there. And another question too, just asking about if there's any future plans to expand to other actuarial fields for pension, collective schemes, Social Security, a collaboration and partnership with the UNDP. At this point, there isn't, but we still have a lot of runway left in the GAIN environment. So if there is uh, a need or desire for other specialties, experiences, actuarial sectors, please share that feedback. We'd love to hear it. We started with these two as we thought these were kind of the lowest hanging fruit, the most accessible types of product for those who are getting into micro insurance itself. But by no means are these representative of the entire population. Even in health, right? There's a much more broad type of product design other than just hospital cash. That's maybe one of the most simplest one as we would just use as a starting point. So.
And Josh, I think I would add to that just if there's interest, I mean, there's a few questions already on stochastic modeling, that if there's approaches to modeling, that would be also another way to expand this sort of work. Yeah, please offer feedback because if it's useful, then there's potential for some examples to be made available to everybody.
Wonderful. Okay, I think that looks the conclusion of everything in the Q&A bank right now. We'll probably pause the Q&A. If there's obviously questions, you could follow up later, but we'll just kind of walk through our conclusion here. Appreciate everyone's attendance and all those great questions so far. So we just wanted to highlight this page. We referenced it a few times, but GAIN is kind of the umbrella Global Actuarial Initiative, which is a partnership between Milliman, our organization, and the United Nations Development Program, or UNDP. This is just one of the wide variety of tools, resources, initiatives that we have ongoing. This program has been running for just over about 3-ish years and still will be going for several years longer. We have a website, which is where you can download these tools as well. So that first hyperlink there, and we could put that in the chat. Maybe Brian, if you could copy that or put that into the chat as well alongside the IA website. Both of those you could download the tool for. And there's also a lot of other information related to the other initiatives that the GAIN has ongoing. We also just recently launched a LinkedIn page. Maybe that's where some of you heard about this announced webinar, but we'll be pushing out more content on the LinkedIn. Great way to follow up with what's going on in the future of GAIN. If you're interested, as well as contributing, getting involved in the program, feel free to reach out there. And then lastly, we have a email address, gain@milliman.com. If you have follow up with any questions there, you could reach out there or anything else related to GAIN, and so one of our GAIN team members will ensure you get a response there. Great, we see a lot of thank yous coming through the Q&A. Thank you as well. And with that, I think we're pretty much right on time. So thank you for all you attendees who made it. Thank you to our panelists here. Thank you to the IAA for hosting this webinar with us. Thank you for all the copious amount of reviewers over the life of this project. This has been a several-year initiative, and we're very excited and thankful to have this finally released to the public. Look forward to your feedback in the future and other things to come. So thank you kindly again, and I hope to hear from you soon.